Welcome back to Alpha Recap, the weekly rundown from stockalpha.ai. Markets were closed this weekend, so we're looking back at what happened through Friday and pulling out the threads that mattered. As always, if you have questions, you can reach us at stockalpha.ai. Ready to dive in?
Yeah, absolutely. Lots to unpack this week. AI momentum, energy tailwinds, and a handful of policy-driven, event-style trades that rattled volatility. So, what really stands out here is how concentrated the market's moves were around a few dominant narratives.
Totally. And to set the stage, Alpha Research sorted more than 500 notes into themes this week. That's a lot of desk time and a pretty clear signal that the tape was busy with conviction and lots of follow-up. Let's start with the biggest headline: AI and the semiconductor ecosystem. Analysts kept reiterating a central role for a handful of companies at the core of the AI compute cycle. And the market treated that like a storyline with teeth this week.
Right. And the other thing is the research notes were really nuanced. They weren't just saying AI good. They highlighted margins, free cash flow, and how sensitive valuations are now to geopolitics and CapEx cycles. I mean, when you step back and look at this, execution and supply really matter.
For one representative name, analysts flagged a forward price-to-earnings ratio of about 21.5, with the stock trading around $166 to $167. So the story is growth plus valuation sensitivity.
Exactly. And the spotlight wasn't just on that one company. Foundries, chip makers, and equipment firms, think of the big equipment names and some memory suppliers, all showed stronger order books and lifted price targets. But analysts warned about capacity constraints and elevated CapEx that could pressure near-term free cash flow.
Let's unpack CapEx for a second in plain terms. CapEx is capital expenditure, the money companies spend to build factories, buy machines, and expand capacity. It's how you turn demand into actual supply, but it's cash that leaves the balance sheet in the short term.
Right. So high CapEx can fuel future revenue, but it can also mean weaker free cash flow today. And when a lot of investors are paying for future growth, they're watching those cash flows closely. That's why Alpha Research kept repeating the theme. Momentum is real, but valuation is the counterweight.
And equipment makers specifically showed revenue and margin tailwinds tied to AI node transitions. The caveat: forward valuations looked rich in several cases, so the sustainability of those gains hinged on smooth capacity ramps and execution.
I was a bit surprised by how consistent that message was across firms. Honestly, I was a bit surprised by this one.
Short reaction.
Right.
Okay, moving to energy and commodities, this was the second big story. Geotensions in the Middle East pushed crude higher, and that fed through to integrated oil names and explorers. Cash flow headlines were strong, and yields in the sector looked elevated.
Yep. Analysts pointed out that integrated oil companies were supporting dividends and buybacks, while refiners benefited from wider crack spreads. But the common caveat was straightforward. If geopolitics calmed, some of the multiple expansion could compress quickly. So commodity sensitivity matters.
For listeners who haven't tracked crack spreads before, that's the margin refiners make turning crude into gasoline and diesel. When that margin widens, refiners can post much better profits even if crude is higher.
And midstream names, the pipelines and storage companies, were getting attention for stable, fee-based cash flows and attractive yields. Analysts still flagged leverage and execution as watch items, though. So it was a tale of cash flow strength versus operational risk.
Short reaction. Next up, utilities, grid modernization, and renewables. Alpha Research highlighted a two-track thesis here: traditional regulated cash flow plus option value from grid work and data center load.
Right, so these utilities look a little less defensive than usual because they have visible multi-year projects tied to renewables and data centers. The trade-off is valuation. Several names were trading at premiums because that growth is visible, but regulatory execution and CapEx timing remain the key risks.
Exactly. So it's not just steady dividends anymore. It's dividends plus growth optionality, which changes how investors think about them.
Short reaction.
Wow, interesting.
When we turn to software, security, and enterprise platforms, the recurring line was valuation tension. Analysts noted solid AI adoption across cloud and software leaders, But many high-growth names are trading at multiples that require persistent execution to justify those prices.
That included everything from data platforms to cybersecurity. The security names are getting a tailwind because generative AI is expanding attack surfaces. But even that narrative comes with a valuation hangover.
Right, and when we say valuation hangover, we mean that price to earnings or other forward metrics already reflect a lot of good news. So any slip in execution or guidance can lead to outsized reactions.
Let's pause and explain forward PE quickly. It's the stock price divided by expected future earnings. If that ratio is high, people are paying now for earnings they expect later. So missed guidance or slower execution can be painful.
Exactly. Okay, switching gears. Healthcare and GLP-1 dynamics. Analysts continued to highlight momentum in weight loss drugs and oncology assets, but they also flagged payer pushback and pricing scrutiny as meaningful risks.
The work on the clinical pipeline and acquisitions also showed up. But again, it's execution and timing that mattered. Regulatory timelines weren't the done deal, and payers could influence uptake materially.
Short reaction. Event-driven and policy trades were another concentrated theme. Cannabis policy and crypto regulation were called out as high-volatility, binary catalysts. For cannabis, a White House meeting was the key near-term event that analysts thought could re-rate some ETFs and names if policy clarity appeared.
And the note on cannabis was important. The narrative framed some ETFs as event-driven rather than steady earnings plays. Without reform, those vehicles stayed structurally fragile. So the possible outcomes were pretty binary.
For crypto, analysts made a careful distinction between spot exposure via trust structures and operational miners. Miners still track Bitcoin price closely, but some miners are trying to pivot toward AI or data center strategies, which, let me say, is an ambitious move.
Yeah, miners wanting to be data center operators. Big pivot. It could diversify revenue, but also requires capital and expertise.
Short reaction.
Right.
Across the report, Alpha Research flags some recurring cross-cutting patterns. First, momentum versus valuation trade-offs. The market was rewarding visible revenue and cash flow momentum in some sectors, but punishing names that couldn't convert growth into durable free cash flow.
Second, macro and commodity sensitivity mattered again. Geopolitical shocks triggered a durable rotation into energy and cyclicals, while higher yields pressured REITs and long-duration software multiples.
Third, capital allocation stood out as a differentiator. Buybacks, dividends, and M&A moves were cited as critical to value realization. Firms that articulated clear plans attracted more conviction in the research notes.
And fourth, policy and regulatory catalysts drove concentrated event risk. Cannabis, crypto, and big payments or fintech headlines can re-rate subsectors very quickly, which means the timing of announcements matters more than ever.
I mean, when you step back and look at this, the common denominator is dispersion. Some companies had very visible momentum and cash generation, while others looked priced for perfection and therefore fragile.
Exactly. Alpha Research also flagged a few contrarian takes that were interesting. For example, the idea that cannabis ETFs are event-driven re-rate instruments, or that some crypto miners pivoting to AI is feasible but risky. Those are the kinds of high-variance calls you don't want to treat as steady-state outcomes.
On methodology, the team leaned on a mix of valuation anchors, trailing and forward PE, EV to EBITDA, price to book, plus profitability and balance sheet checks like free cash flow and net debt to EBITDA. They also used event overlays to time potential catalysts.
Which brings us to their practical implications. Their take was analytic, not prescriptive. For AI hardware exposure, monitor order book transparency and CapEx cadence. For energy, keep an eye on CapEx and deleveraging plans. For event trades, watch policy news and NAV or discount dynamics. For utilities, watch regulatory filings and rate case timing.
Right. And Alpha Research's agenda for next week focuses on earnings, major first-quarter prints where management commentary on AI monetization, CapEx, and margins will be central. They called out a handful of names to watch for these conversations and said they'll produce earnings read briefings isolating estimate revisions and capital allocation updates.
They'll also follow the White House cannabis meeting and any department-level announcements that affect financing for the industry, monitor Bitcoin flows and trust discounts, And keep an eye on semiconductor capex cadence and memory spot prices. So a very event-heavy week ahead in their view.
A couple of quick explainers before we wrap. When analysts talk about NAV discounts for ETFs and trusts, they mean the difference between the market price of the ETF and the value of the assets it holds. A widening discount can signal liquidity or regulatory risk. A narrowing discount often reflects policy clarity or inflows.
And when they talk about miners pivoting to AI workloads, that's a shift from being purely Bitcoin price sensitive to trying to sell compute or provide hosted services. It sounds smart on paper, but it's capital intensive and operationally complex. Different skill sets entirely.
Yeah, that tracks.
All right, let's close with clear takeaways.
First, AI hardware and semiconductors drove headlines with real momentum, but execution and capex rhythm are the key filters analysts will use next week.
Second, energy rallied on geopolitical shocks and delivered strong cash flow stories, but those moves are sensitive to de-escalation risk and commodity reversals.
Third, utilities and renewables are morphing into growth plays in some cases. Regulated cash flow plus optionality. But regulatory timing is the watch item.
Fourth, event-driven trades. Cannabis and crypto trusts remain binary. These aren't steady earnings investments. They hinge on policy windows and NAV dynamics.
Fifth, across sectors, valuation discipline matters. Momentum is real, but many leaders trade at stretched multiples that depend on flawless execution.
Final thought. Alpha Research emphasized scenario-based analysis and sensitivity checks when multiple expansion is priced in. The data suggests that next week will be about earnings cadence, policy headlines, and whether execution lines up with growth expectations.
If you want to dig deeper into any of these themes, remember you can ask questions at stockalpha.ai. We'll answer the ones we can and point you to the research that supports our talking points.
Thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. See you next week.